inspiring people with curious minds, harnessing data and technology, working seamlessly and inclusively, always learning from patients. AstraZeneca R&D, helping unlock the power of what science can do.
AT&T is helping business move forward, and together, we've changed the way things get done. From redefining collaboration,
top of the line here,
to coming up with new ways to serve customers and deliver products.
This one is cheddar. It's delicious.
So as your business keeps moving forward,
Oh, you look so healthy.
you can rely on the people and the network of AT&T to help keep your business connected. Let's take care of business. AT&T.
Thank you for joining us. Our program continues now.
Wow, what a morning. We've had over 800 viewers, and the energy, intellect, and passion has been contagious. If you're just joining us, my name is Marty Rosendale, and I'm the CEO of the Maryland Tech Council. I want to thank everyone for joining us and thank our first three panels for their contributions today. All of the sessions this morning have been recorded and will be available to download. In just a few minutes, we will hear from our keynote speaker, but before that, I'd like to take a moment to share with you the Maryland Tech Council's policy priorities for 2022. The Maryland Tech Council, along with the executive members of its legislative coalition, work throughout the year to create a unified voice for industry advocating for the issues that are critical to Maryland's businesses. The past 2 years have shown how vital it is for industry and government to work together on shared priorities to overcome a public health crisis. In 2022, MTC will again serve as a leading industry authority as Maryland continues its recovery from the health and economic impacts of COVID-19. This year, we've identified the following priorities to advance at the local, state, and federal level. We will protect Maryland's innovation ecosystem and investments in research and development for future medications and therapies, cybersecurity, advanced manufacturing, and artificial intelligence. We will promote job growth by advocating for risk capital and workforce development incentives. We will push to sustain the COVID-19 response by promoting policies that support development and manufacturing of diagnostics and treatments for COVID-19. With many returning to both virtual and in-person environments, we will advocate for strengthening infrastructure through increased 5G deployment and the development of technologies that save, protect, and improve lives. We will boost competition and access to capital, two of the cornerstones of Maryland's innovation economy. We'll do so by encouraging equity investments in innovative companies, including tax credit incentives. And lastly, we will promote policies that enhance data privacy without unintentionally weakening consumer privacy or increasing security threats. These 6 priorities will protect and enhance the innovation ecosystem that lies at the heart of Maryland's economic strength. Industry cannot achieve these goals alone. It requires a collaborative effort between industry and policymakers in Annapolis, on Capitol Hill, and local jurisdictions across Maryland. As we move forward in the 2022 legislative session, we look forward to working with the General Assembly and the Hogan administration to achieve our shared objective of a world-class innovation economy. We will be sharing these priorities via email and social media, and you can also download them at mdtechcouncil.com. So now I'd like to introduce Chris Carroll with AT&T, our title sponsor this afternoon. Chris serves as a Regional Director in External and Legislative Affairs for AT&T Services, Inc., and in this role, he advances AT&T's legislative, regulatory, and external affairs agenda in the District of Columbia and Maryland. Prior to joining AT&T, Chris served in Maryland's state government, where he was policy and legislative director to Governor Larry Hogan, and most recently as chief of staff for the Maryland Department of Information Technology. So Chris, I want to thank you for all your support. Thank you for everything that you do, and I'll let you take it from here.
Thanks, Marty. Appreciate the opportunity to join you all again this year and commend the council for all the great work that is happening. And also, I look forward to joining you all later for the panel discussion on protecting innovation and broadband access. At this time, I would like to introduce our keynote speaker, Stephanie Roth, who will give us an overview of what's in store for the U.S. and global economy in 2022. Stephanie Roth is a Senior Markets Economist for Global Wealth Management at JP Morgan. She sits on a global macro strategy team where they drive the top-down markets views for the platform, specifically on the outlooks for the economy, fixed income, and currencies. They recently released their 2022 outlook, which is grounded in a solid outlook for growth and slowing inflation. But unlike 2021, there are significant cross currents to be mindful of in the year ahead. We asked Stephanie to join us today to share her outlook for the US and global economy in 2022, including forecasts for GDP growth, outlook for supply chains impacting technology and life sciences, consumer spending, and inflation. Stephanie will also share insights on the Federal Reserve's anticipated interest rate changes and their impact on the American economy and equity markets. We're very fortunate to have Stephanie join us today, and I would encourage you to submit your questions for her to myvoice@mdtechcouncil.com. With that in mind, please join me in welcoming Stephanie.
Great, thank you. Thank you for having me. It's great to be here. So it's important to note, and let's bring up the slides. We have a slide deck here for you. The cycle here should be very vibrant. So even though there's a lot of cross currents and it might feel like inflation is high and it's hard to, go to a certain restaurant because they're having staffing issues, at the end of the day, all of this is happening because demand is very strong. And we're facing supply chain issues as a result of just a shift in demand, yet consumers remain very robust. And we think that will remain the case in 2022. So we expect consumer spending to be very solid. We expect GDP to be above 4% for this year. That's very much above trend. But we recognize that it's a little bit more challenging of environment than what we faced in 2021. So the Federal Reserve is getting ready to hike interest rates, and that's certainly what's creating some of the volatility in equity markets that we've seen over the past couple of days. Now, that shouldn't be overly concerning given the cycle should continue. This shouldn't necessarily end the cycle. We're very, very early in the interest rate path. We haven't even started hiking interest rates. We're very, very far away from neutral interest rates, where that tends to become a bit more challenging for the economic impact. So right now we're at a phase where growth should be very solid, and investing, it becomes a little bit more complicated, but also very interesting. It's important to really own the right assets in this type of environment, because it's not just about a recovery anymore. It's about what assets will do better in this type of environment, what assets will handle the cost pressures that we're seeing today. So it's more about getting alpha over beta when you're thinking about this investing in this type of environment. We very much expect inflation to slow this year. This should be around the height of the inflationary prints that we're seeing. Inflation headline CPI has just reached 7%. That might seem overly concerning to a lot of people, but we do very much expect it to slow. And we think a lot of that was due to some of the supply chain issues that we've seen. So if we go to start with the first slide, this is just a brief view in terms of how we're seeing things. Vibrant cycle. Priorities should be very solid for the developed world. Businesses and consumers remain robust, and it should also foster an innovative environment. This inflation that we're seeing, yes, it's a challenge today, but that's a good thing for businesses because they tend to invest in this type of environment. Having inflationary pressures or challenges tends to foster change, and that's not necessarily a bad thing. We should see a better productivity as a result. So let's go to the next slide. Now, like I mentioned, a lot of the challenges that we're facing are a result of very strong demand this cycle. And here we show on this slide the recovery this cycle, that's the purple line, compared to the blue line, which was after the great financial crisis. Now, the purple line fell very quickly, but it also recovered very quickly too. Very, very different from the recovery that we saw after the financial crisis. So we shouldn't compare today's recovery to necessarily what we saw back then, because it's very different. This almost looks more like a natural disaster than a more traditional recession. And that has helped keep the recovery a lot faster, and certainly what we saw last cycle, or than what we've seen before many recessions. And that's not a bad thing. It's a function of what we're seeing in this type of environment, and that's why everything has happened so quickly. That's why the recovery has been fast. That's why there were limited bankruptcies. And I would attribute that to a combination of fiscal policy being very robust, that helping monetary policy, also helping to support the banking system and companies from a big default cycle. And also the nature of this recession. The economy didn't slip to recession because it was filled with a lot of excesses. It fell into recession because of a pandemic that hit. So it's a different type of recession than one that was driven by specifically the business cycle itself. Now let's jump to the next slide. I mentioned that fiscal and monetary policy were very supportive for this recovery. And that certainly has helped the consumer remain very healthy. Now on the left-hand side of this page, we show household net worth as a share of GDP. Basically, household savings have risen pretty significantly as a result of this pandemic, which might sound strange, but the combination of investment portfolios doing very well, house prices appreciating, people certainly received a number of checks to help support their families. That has helped the balance sheets of consumers remain really healthy, which is very different from what we've seen in previous cycles where balance sheets actually deteriorated after the recession. On top of that, interest payments are very low. That's a function of interest rates themselves being very low. So the interest payments that you'll be making are also a function or a reflection of where interest rates are today. So the combination of those two has kept the consumers to be incredibly healthy and demand to be very strong. Now that has created complications because consumers feel really healthy. They did a lot of spending because they spent a lot on goods. That created a bit of a supply chain bottleneck. But we're starting to see very early signs that that's getting a little bit better, and we can get into that a little bit later. But we do see that the worst of the supply chain issues are behind us. Now, I mentioned that we're in the mid-cycle of the economic recovery. That typically is a function of, and maybe let's jump to the next slide. That's typically an environment that tends to be good for risk assets. It tends to mean very solid returns, although maybe lower than what you saw in the early cycle. But that's okay. You can't sustain 25% equity market years in the long run. That would create a bubble. So we don't necessarily want to see that anyway. So this type of environment is a good environment for investing, good environment for the economy. You just have to recognize where we are. And we put together a proprietary indicator to help us gauge where we are in the cycle. And a lot of people, or a lot of economists at least, have their favorite recession type indicator or business cycle indicator. We just think that it's better to combine a number of those, so we're not cherry picking sort of where we are in the cycle. So when we combine a lot of these indicators, that gets us to this picture here today. And it basically puts us right in the middle of the chart, which tells us we're in the middle part of the cycle and we're sort of firmly there. And yes, it's only been a couple of years since the recession hit, but the recessions have nothing to do, or business cycles have nothing to do with length of time. It's truly about excesses that are in the economy. And it's about slack that's in the labor market, or how many people are available for labor and what's going on in terms of wages. So because of the recovery, we've gotten to mid-cycle rather quickly, and that's okay. It's just a function of understanding how we got here and what's been driving this cycle so far. So I mentioned that there are some signs of inflation, and inflation is a really important piece of this whole mid-cycle or really business cycle for that matter. And as you progress throughout the business cycle, inflation tends to start to increase. Now, the inflation that we've seen over the past year or so isn't really related to the business cycle. It's related to bottlenecks and goods inflation in particular. And let's jump to the next slide. Here we show for you on the left-hand side of this page, we show goods inflation versus services inflation. Now, the line that's going pretty much straight up is the goods inflation that we've been seeing. Now, that's not really a symptom of where we are in the economy. Like I mentioned, that has to do with all the supply chain issues that we're seeing, shortages of various goods. And that's really the inflation that a lot of us are feeling and seeing on a day-to-day basis. But the good news is that's getting better. And it tends not to be that sticky. It doesn't usually last, especially given we know that it's driven by certain bottlenecks. We very much expect that to fade. It's really the services inflation, which is more important for inflation at the end of the day. It represents about 2/3 of the inflation basket. This is the inflation that we should focus on, because that's really tied to the economic cycle. Services are an important part of this economy. And goods inflation really just isn't that important, even though it has been, pretty much shocking how strong goods inflation has been. It should go the other way. And historically, when you see shocks to the system, similar to this to some extent, it tends to slow pretty quickly. So that purple line should come down rather quickly, and we expect that to happen this year. Something that you're starting to see on the right-hand side of this page just shows some early signs that the supply chain issues are getting a little bit better. This shows the just some prices related to semiconductors and ship transportation, and that certainly has come down. So the early signs about inflationary pressure starting to cool as it relates to the supply chain issues are really looking positive. But what we really should focus on is the inflation that actually matters for this economy, and that would be the service inflation. And the two key drivers of service inflation, when you take a step back and really want to understand the most important components, are related to wages and shelter. Shelter inflation has nothing to do with house prices. It's related to the rental market. And those are the two sort of key critical components when you're thinking about inflation and what's actually sustainable and sticky. So let's jump to the next slide. The wage inflation is something that might stick with us for a little while. Wage inflation has certainly been very robust recently. It's been acute in a couple of sectors, and we think that should cool a little bit. So retail in particular and hospitality, wage inflation has been incredibly robust there. We think that there's good reason to believe that should get a little bit better. A combination of COVID has been keeping people out of work, and certainly with rising cases recently, that has just continued to some extent. But also the generous benefits that have been given to people over the past year or so has kept a lot of people out of work. Now, they served a very important purpose, but what you saw especially towards the end of last year, was that people didn't want to come back to work because they were being paid more to stay at home. So the unemployment benefits were generous, especially for the low wage worker. Now that they've expired, we expect the workers to eventually come back to work. The new wave of the COVID variant might delay that to some extent, but we still expect that people should eventually come back to work, and we should see a little bit of an easing, at least at the lower end in terms of worker shortages. Now, wage inflation should still remain fairly robust. We are in the mid part of the cycle. That chart I showed you earlier, the line was right smack in the middle of mid-cycle, and mid-cycle tends to be an environment of very solid wage inflation. It's an environment where workers tend to demand more in terms of wages, and companies are able to pay it or have to pay it because there's fewer and fewer workers to hire. So they need to compete for the additional worker. It's a little bit of a supply and demand situation for the worker, and that tends to favor the worker, which is what keeps wages a little bit more elevated. Now, what we've seen over the past couple of months is the unemployment rate in particular has fallen pretty dramatically. And that's a great gauge of sort of slack in the labor market. And we're now at below 4%. We're at 3.9%. Now, keep in mind, just before the pandemic, the unemployment rate was at 3.5%. So we're getting close back to where we were before the pandemic. We're not totally there yet. But what's even more noticeable or notable is that the unemployment rate has fallen dramatically over the past couple of months. In the past 6 months, just for example, it's fallen about 2 percentage points, which is pretty dramatic for just a short time period, which is one reason why the Fed has shifted a little bit more hawkish recently, because the labor market is just recovering very, very, very quickly. And if you look on the right-hand side of this page, this shows job switchers, people who are changing jobs and their wage gains. And you certainly see that people are being paid to sort of switch jobs, and they're able to sort of capture a wage boost as a result. And that tends to be a function of an environment where the labor market is actually fairly tight. So people are feeling comfortable to quit their jobs, they're feeling comfortable to find a new job, and they're being paid to do so. This is a good environment for the consumer. It tends to be a good environment for spending, just because you're getting wages in pockets, especially given that will be at the same time that inflation is slowing. But keep in mind, it's not necessarily good for everybody involved. It is a challenge for some companies, because companies are the ones that are paying the wages. So, while the worker is winning, that's good for many consumers, it is a challenge for certain companies. And you're seeing some companies are talking about that in their earnings reports, that they're having trouble in terms of paying and keeping and attracting talent, and they're having to pay up to do so, and that does hurt some companies' margins. We think for much of this year, margins should be fairly steady, but this is something to watch out for, just because it's an important dynamic, and it's a really important part of a lot of companies' costs. So when thinking about, the investment landscape, keeping in mind that certain companies are more susceptible to wage increases than others. Some are more labor intensive, and some are less innovative. So the more innovative companies are going to be able to handle the wage increases a little bit better. They'll be able to invest in technology and capital spending that will help to sort of alleviate some of the pressures from the labor market that we're seeing. Now, the stock market has gotten a little bit wobbly over the past couple of weeks. Granted, it's only down a couple of percent since the start of the year, but it always feels bad. And one big reason I would attribute that to is the interest rate increases that we're seeing, and that another hike has been priced in the market over the past couple of weeks. And let's jump to the next slide. The Fed is getting ready to remove accommodation. They're recognizing that the recovery has been robust. They're looking at a lot of the same charts I showed you earlier, and they appreciate that the economy doesn't necessarily need that type of accommodation that we've seen. So it's just natural to start removing accommodation. Now, what are they doing? First, they're starting with they were doing quantitative easing. They're paring that back. That's called tapering. And they were planning on ending tapering initially. They were planning on ending in June, but they've since doubled the pace, and they're going to end it in March. Now, the economy doesn't need that type of accommodation. Quantitative easing doesn't make sense in this environment, given the recovery that we've seen. So that's why the Fed announced in the December meeting that they'll be doubling the pace of the taper, and it will now end in March. That's not really what's rattling markets right now. What's rattling markets is more about interest rates and the rise in interest rates, and the market just digesting the increase in interest rates that we've seen. But there's something to keep in mind. Interest rates are still incredibly low. So the interest rates that we're likely to see this year are going to have a very, very small impact on the economy. And none this year, and the impact on 2023 is something to watch out for, but it should be very modest as well. Now, it became a problem in the last cycle when the Fed hiked up towards about above 2%, around 2.5%. Interest rates are still at 0%. So we have a long way to go before it becomes a problem for the economy. The economy is very healthy, it can handle it. But of course, the market is always sort of, cautious about interest rate increases. It has to digest it. And that's what's causing some of the volatility today. We expect the Fed to hike interest rates 3 times this year, and 3 to 4 times for next year. So that's a sort of healthy hiking cycle, and we expect that the Fed will only start hiking interest rates because they expect they can go through with a consistent and steady hiking cycle. They're not hiking with the expectation of just hiking once or twice. They're expecting on having a legitimate and longer term hiking cycle. Now let's jump to the next slide. I mentioned about the tight labor market. We talked a lot about that. And what you're seeing is the accommodation and food services in particular are dots on the top left-hand side of that chart on the first one on the left. So what you're seeing is the labor market for the lowest wage workers is particularly tight. So it's a downward sloping line showing the change in earnings versus the dollars that they're earning. So at the lower end, that's the left-hand side of the chart, they're seeing the highest wage growth. So it's an interesting dynamic that the Fed is facing, and they want to get ahead of it. This is sort of an insurance policy to some extent. They want to start hiking interest rates to the extent that we are seeing elevated inflation, especially on the wage front. They want to make sure that they're on the path to hiking, because that's the prudent thing to do. They have 2 mandates. Their mandates are related to inflation and full employment, and they need to keep those 2 in check. We've already met the inflation side of the mandate. We're already averaging inflation above 2%. And the second part of the mandate is employment and reaching full employment. And the Fed has now acknowledged we're very close to that, which is why they're comfortable raising rates in the near term. So that's why we expect there to be 3 interest rate hikes this year, and for the Fed to start quantitative tightening, which is rolling off some of their balance sheet. That should have more of a limited impact on the economy and markets, but it's something that the market is also sort of grappling with at the moment. Now, on the right-hand side of this page, this shows software innovative spending as a share of GDP. This economy has become very innovative and pulled forward a lot of innovation into just a couple of years. And we expect that to continue to some extent, especially given the wage increases that we're seeing. Companies will become more innovative as a result, because they want to be able to handle the rising costs, and they want to protect their margins. So this is not necessarily a bad thing. Even if it creates some volatility for some of these companies, it's a good thing longer term for this economy. We want to see innovation. We want to see capital spending. We didn't have much of a capital spending cycle last cycle. Capital spending was fairly sluggish. So we really want to see a pickup in capital spending this expansion. That would be a really positive thing for this economy. So the fact that we're seeing elevated wages could spur some of this type of spending, which is really not a bad thing. Now, I mentioned that the Fed is hiking interest rates, but we shouldn't be overly concerned about that. Let's jump to the next slide. Here we show the shadow interest rate, which is really just the interest rate that's adjusted for quantitative easing. And basically the point of this chart is it's below the zero line, which tells you that interest rates are very stimulative today. Once it gets up towards the zero line and above, then interest rates or monetary policy is a bit more restrictive. We're a very, very far way away from policy being really restrictive for the economy. So there's a lot of room for a number of interest rate hikes before it has any impact on the real economy. Maybe a more tangible way to think about that is through borrowing costs. And on the right-hand side of this page shows borrowing costs for a typical type of corporation. And it's very far below the trend that we see in growth. So basically it tells you that the decision to borrow to finance investment is a good one. Interest rates are very far below what they would expect to return on that investment. So it's a very attractive environment for capital spending, and we're fairly optimistic on capital spending this year. We think it could actually surpass the pace that we would be expecting for consumer spending, especially as inventories remain low. Companies need to invest as a result, and demand is very strong. So we expect capital spending to be very solid this year, and especially since interest rates still remain accommodative, it makes sense for companies to do so. Now, rates have certainly risen quite a bit over the course of this year. Let's jump to the next slide. But rates tend not to move so slowly. It's typical for rates to move quickly, and then they tend to get digested by the market. So that's what we're seeing and what we expect to continue to see. Interest rates for this year, we expect and we're talking about the 10-year interest rate here. We expect that to hit 2.15% by the end of this year. And we think the path from here to there won't necessarily be a straight one, but we do expect the path of travel to be higher interest rates, certainly rather than lower interest rates. And when we're talking about investing in rates and portfolios, we would be waiting till rates hit closer to our target of 2.15% before we would be adding duration into portfolios. So that basically is saying we still expect rates to rise, so we wouldn't be buying very long duration bonds at this point. We still think that there's more interest rate increases to go. Now, one thing to watch is the housing sector, because that's one of the most sensitive areas when it comes to, and I'm on the next slide, it's one of the most sensitive areas of the economy as it relates to interest rates. And right now, housing sector is doing very well. There needs to be a lot more investment in the housing space. There's certainly a lot of demand. Interest rates are not crowding out demand today. And we expect that to be a long-term theme for this economy. We expect the housing sector to continue to grow in a pretty substantial way. We expect that home builders will continue to build, because there's a lack of property for this economy. And you're certainly seeing that in some areas, specifically in the South. That's been a big area where people have migrated to throughout the course of the pandemic. So it's been a bit of a mix shift and the need to sort of digest the movement of people throughout the course of the pandemic. The pandemic has changed people in a lot of different ways, and I would say that housing is a key component there. A lot of people have left cities and have moved to the suburbs, and interest rates still remain accommodative enough for that to happen. So, rising mortgage rates is not a headwind right now for consumers, especially since they remain historically very, very low. Right now, the restraint on housing is more about the supply. There's not enough houses to buy, but eventually we expect that supply to come online. It just takes some time. I painted a very optimistic outlook of the economy, and we do feel very good about the outlook. We think stocks are more attractive than bonds today. We would be, further out on the risk spectrum, although it's important to note that we would be up in quality, and we would be starting to think about a mid-cycle portfolio. We would be starting to invest for not the early cycle where the market tends to show just very strong returns. We like to invest for today's environment, which is one where it's a little more volatile. And we want to make sure that our equity portfolios are up in quality. We also like real assets, just given they tend to do well given the inflation environment. But we definitely recognize that there are a lot of cross currents, or there are challenges. And let's jump to the next slide. This is the point in the cycle where we tend to focus on the risks, because it's not all about that sort of easy rebound off the bottom. Now it's about some of the challenges facing the economy. So it's important to keep those in mind. Now, the first one we spent a lot of time talking about, which would be related to inflation and monetary policy. Our expectation is that inflation should slow pretty dramatically, that wages should remain around 4% rather than accelerating much further than that. But if we're wrong on that front, then monetary policy will have to be even more restrictive. It will mean that there'll be more hikes than we're expecting in our outlook. And like I mentioned, we're expecting three rate hikes this year, and then 3 to 4 next year. If we're wrong on the inflation front, that would mean that there would have to be more hikes than that. And that would mean the Fed would have to tighten policy, more significantly, which would be a challenge to the economic backdrop. We don't think that will happen, but this is something important to watch out for. And I would say the wage backdrop is probably one of the most important drivers for this. We need to really make sure that that wages don't get too far out of control, and we don't think that they will, but the Fed will be mindful of that. The second important thing when it comes to monitoring cross currents or some of the challenges out there would be China. China is a complicated part of the EM world, especially over the past year or so. China has tightened policy pretty dramatically, and that slowed growth. That certainly hurt their stock market, but this is something that's very deliberate on their part. They're trying to deal with their excesses. They're taking advantage of the strong export environment that they're seeing, and they tighten policy. So as of now, it seems fairly contained. The housing market has been sort of the key area that they're focusing on. China has a lot of excesses within real estate. Our expectation is that growth slows modestly there. We're expecting 5.3% GDP growth in China. Some people question the numbers. Regardless, we expect Chinese growth to slow modestly throughout the course of this year. But that could always be a risk to the outlook. If Chinese growth slows further than expected, that could always be a bit of a challenge. Our base case is that it's a bit more modest than that. And then, of course, the virus is always a challenge. Our expectation is what we've experienced so far is that the economy has become less sensitive to COVID over the past couple of waves, and we expect that to be the case. But if there became a wave that did not work with the vaccines, then of course that would be a different kind of challenge than we're facing. Right now, we're seeing vaccines are working well with the Omicron variant, especially if people are boosted. The hospitalizations have been very contained, especially considering the case growth that we've seen. So if that were to change or things were to be different, that would be a challenge to our fairly optimistic outlook. So I would say this is an environment where the economy should be very solid, consumer spending should be good, capital spending should be solid, but we have to be very much in mind about what the Fed is doing, because that tends to certainly drive the markets, and to the extent that interest rates drive the economy on a lag, that's an important factor thinking about our sort of future growth outlook. I'll pause there. I think a couple of questions came in.
Thank you, Stephanie. We do have a couple of questions that have come in. So first off, question one is, do you think the trend you are seeing will support continued strong venture capital and private equity investment?
Yes, we certainly are optimistic in that space. There's a lot of opportunities on the private equity space, a lot of sort of innovation and disruption in that area. So we think that should be an important part or important component for them. Interest rates should also remain low. So that will be an important aspect, just given the ability to invest in other companies should be still accommodative on that front. Of course, as interest rates rise in a significant way, maybe the dynamic will change. But like I mentioned, we're still a far way from that environment. And then from our clients' perspective, we very much like that for their portfolios. We think it's a solid for clients that don't necessarily need the liquidity. We do very much like private equity. We think it's a good asset for our clients to hold, especially since it tends to be less sensitive to gyrations within the economic cycle and as well as inflation. So we sort of like it from both angles. We think there's a lot of opportunities on that front. And then we do like our clients to have a piece of that investment universe as well.
Excellent. The next question we have is, do you think we will see a period of deflation?
That's a great question. So I think there's a chance of that. I think there's a chance, at least on the goods side. Goods inflation should slow pretty significantly. We spent a lot of time on that. We don't need to get into why. But I would say there's a chance that inflation sort of misses to the downside. And maybe we're not seeing negative inflation prints, but it's possible that we'll see inflation disappoint, just because people tend to sort of overproduce given the environment. And that's very common for companies. Companies expect demand as it is today. And if demand doesn't remain that robust, you might end up in a situation where investment is actually too much and we end up with too many inventories. And in that scenario, it's very possible you'll see goods deflation. I do think that we're far enough in the economic cycle where you'll still get that services inflation will still remain fairly robust. So it's unlikely that we'll see, negative inflation prints overall, but we could see inflation at least miss to the downside. So sort of surprise people in the other direction. It moved very quickly in one direction on the way up. So it's likely to slow down pretty dramatically also on the way down.
Excellent.
Now jumping back, yeah. Now jumping back to the presentation, we just had a couple more slides to go through. And of course, if there's more questions, happy to take them. So let's jump to the next slide. Perfect. So now we're still talking about cross currents here, and companies are very much thinking about the supply chain easing, and this is a risk to our outlook. And something that has come up more recently is related to the supply chain conversation, but a little bit more nuanced than that, related to China and China's zero COVID policy, because it's worked okay for them so far to some extent, where they've been able to stop the spread of COVID cases. It's sort of in its track. But there's always the risk that China ends up having either a more significant COVID outbreak, and then they need to make a decision. Are they going to continue to stop economic activity, or are they going to let COVID rise significantly throughout their economy? And it's a challenging decision. I don't envy them for having to decide that. But they're in a very complicated situation. And why is this related to the supply chains? Well, much of our goods came from China. So if China ends up having to either close in a significant way, or they allow COVID cases to rise so much that it does start to impact production, that could make our supply chains worse. even though we're already starting to see signs that things are getting better, it's possible it could go in the other direction. So it's something just to keep in mind. China is sort of grappling right now with the decision around zero COVID. Right now, they're not wavering from that. They're still planning on stopping COVID right at the source. So they really have stopped COVID outbreaks pretty much immediately, but that is always a risk just to some extent when we're thinking about the supply chains. Now, I mentioned earlier that COVID has become less important for the economy. Let's jump to the next slide. Here's just a couple pictures on that. So here are spending trends as it relates to consumers on their credit cards. And you see that initially you saw a very sharp drop off in spending. Certainly when COVID hit immediately, a lot of consumers stopped spending. And over time, you've seen a lower correlation between the impact of COVID cases and spending. But as long as things continue in this way, we don't expect it to be all that dramatic of a problem. But it's certainly something to keep in mind. That if we were to have a challenge as it relates to another wave that doesn't work with vaccines, the outlook could look a little bit different. Not on our base case, but always something to keep in mind. Now let's jump ahead 2 slides. The next 2 are about China. I think we covered that well. That's dealing with the property sector. They're very much trying to crack down on that. House price to incomes are incredibly high for China, so that's what they're trying to deal with, and that's why they've cracked down on leverage within their economy. They want to focus on income inequality, and that's very good for China longer term, but that's been a little bit painful over the past year or so, and we should continue to see more of this. China is focused on its long-term objectives, and cracking down on the housing sector is certainly one of them. Now let's jump to the next slide. And perhaps we can end here unless there's additional questions. This is a key pillar of our mid-cycle playbook. And here's how we think about investing throughout the course of mid-cycle. And I alluded to a couple of these points earlier, but I think it's important to reiterate. So mid-cycle tends to be an environment where costs are starting to rise. You're seeing certainly that wage pressure, and we think that will stick, especially given where we are in the cycle. And it tends to be an environment where correlations between sectors and styles tend to be very different. That means assets tend to perform very different from one another at this part of the cycle. So if you look on the left-hand side of this page, this is an important part of sort of where we are in the cycle, and we should expect clients and those invested in the market to really focus on what they own in a portfolio, because that's really important at this part of the cycle. So really being mindful of the sectors and styles that you own are really critical, because there tends to be a lot of dispersion within the market at this part of the cycle. On the right-hand side of this page, we just put a quick snapshot of how assets tend to perform at various points of the cycle. Mid-cycle returns tend to be a little bit lower than early cycle, but pretty solid. It tends to favor U.S. assets over non-U.S. assets. So U.S. assets tend to do a little bit better, and that we tend to prefer certainly the U.S. over non-U.S. We also prefer developed markets over emerging markets, and that tends to be the case at this part of the cycle. Interest rate policy, when that's getting normalized, tends to be a bit of a challenge for some of the emerging market countries. And that has certainly played out over the past year, and we expect that to be a little bit more challenging for the rest of this part of the cycle. The dollar tends to be fairly strong. And then gold tends not to do very well at this part of the cycle, and we continue to believe that will be the case. So at the end of the day, we think this is a really robust economy. We think the cycle still has legs, even though the early part of the cycle went very quickly. That doesn't mean the rest of the cycle will progress quite as quickly. Possible we actually slow down on the brakes a little bit, and the economy continues throughout mid-cycle rather than rushing through it as we did earlier in the cycle. So the backdrop is very solid. The consumer should continue to be very, very robust. Balance sheets are healthy. And then you also have the benefit of the CapEx side of the economy. Certainly businesses will invest, and consumers certainly still want to invest in housing. So those are 2 other areas of the economy in addition to the consumer that should remain very solid. So I can pause there. I think there might be one more question.
There is, and thank you for that, Stephanie. The question is regarding house prices. Our price to income ratios seem high. Is that sustainable?
So the chart that we're referring to here was really highlighting, it's maybe one chart before this, if we can possibly go back. These are house price to incomes by city. Now you'll see the purple bars are China, and this is looking broad. This is looking across the entire world. So it's sort of mind blowing that China represents so many of these high bars, and that's just a symptom of speculation within their housing market. There's only so many places for Chinese investors to invest. The capital markets are not necessarily open there, so money tends to flow into housing, sometimes the stock market, or it tends to go into savings. So people tended to buy several houses as investment properties, and that's what drove up house prices. China wants to address this, and they don't want house price to income ratios to be quite this high. This is not sustainable. This is not something that they want to see, and it's crowding out the investors or the sort of first-time home buyers. So it's really becoming a challenge for their economy, and they want to address it. This chart makes also, say New York, for example, look, incredibly small. And we all know house prices in New York aren't necessarily cheap, but at least compared to China, it looks lower down on the list. So, even when we talk about house prices in the US, house prices have climbed quite a bit. We think that they should moderate from here. We don't expect the same type of house price appreciation that we've seen. That sort of fit to some extent with the asset price inflation that we saw over the past year as well. So certainly China's actively trying to mitigate the problems within house prices in their economy, but our business cycle should also do that for the US as well. We don't expect house prices to fall, but we do expect them to grow at a slower pace than certainly we've seen over the past year.
Thank you. So I had a question as well. Just going back on interest rates, I know there's a lot of angst and concern about interest rates. Just generally, I mean, are higher interest rates, or where we are now, is that a sign of the economy being healthy, or is it a sign of concern? Just get your take on that.
Sure. So I would say the level of interest rates today are still below what I would expect them to be in the longer term. In the longer term, a signal of sort of neutral interest rates should be somewhere between 2 and 2.5. So we're still a little bit below that. So I would say it's a symptom of an economy that has recovered. We've gone a long way. It's certainly an economy that has recovered to some extent. Certainly a healthier interest rate than what we were, say, a year ago. But there's still some more increases to come to really signal sort of where we are and what the long-term interest rate should be for this economy. About a year ago, I would say that really was concerning. Interest rates shouldn't have been, with around 1%. So closer to 2% is a healthier rate. We had a slide in here showing the ranges throughout the course of the cycle, and we would expect that cap of around 3%. So we would not expect rates to be much above 3% in a given cycle. This is not the same economy that we were 20 years ago. Inflation is structurally lower. Growth rates are structurally lower. So trying to compare today's interest rates to a long time ago is not really an accurate comparison. So I would think about that sort of range from the 0.75 to 3% as a normal range throughout a business cycle in today's environment. So we're certainly closer to that 3%. And we think, rates should be a little over 2% as sort of the longer term rate. So we're certainly getting closer, but not quite there yet.
Great. Stephanie, I want to thank you so much for your time this afternoon, and really appreciate your enthusiasm and the optimism that you're presenting as well. So thank you so much.
My pleasure. Thanks for having me.
And Chris, thanks for your support. Thanks for your help today. And everyone joining us, please join us for the next session on protecting innovation and broadband access. Thank you.